Dion, thank you so much for being here. Appreciate it.
Hi, good morning, ladies and gentlemen. Thanks for the opportunity. So my presentation's a little bit different, some of the same themes, but I was asked to talk a little bit about the equity market from a top-down perspective. So I'm not really touching on stocks, and I'm also not doing any marketing today. So I'm going to create more time for questions, so please do jump in. Okay, so in a top-down equity market outlook, there's always generally we have to do our disclaimer. Today's disclaimer is a little bit different. I'm going to take us back 2 years. Think of most market participants would have told you, given the amount of interest rates increases that we've just stomached, that it's basic business cycle economics. We will see some shape and form of a slowdown. Most fund managers, most economists will tell you it's coming. It's the economy, stupid. In the short term, it was actually a little bit different. AI has told us, look, this is something you need to think about. You guys are not as smart as you think you are. And I think that's kind of core to our philosophy at Fairtree, is that you always have to take what is basic common sense principles and adapt to what is today. And today is a little bit different, but we know some of these serious drivers are still there in the economy. So that's why the US has continuously beat. If you look at consensus expectations the last 2 years, consistently above trend growth. US exceptionalism impacts the whole world. This year, 2025, we see a little bit of slower growth, mostly driven by Liberation Day policies and some of the impacts that tariffs have on growth expectations. But if we were to take the AI structural theme out of the market, you can see there right at the bottom, sorry, I'm used to having a pointer, you could see that we would be quite close to a contractionary environment for the US economy. So that's something we need to think about a lot in the SA economy. Remember, global growth, Chinese government, US consumer are the two biggest drivers, and we as a small open economy and our stock market is impacted by that to a large extent. So that AI capex, what I'm talking about, how big is it? How should we think about it? Well, it's a seriously big number in 2025. You can see moving just for these hyperscalers, moving from $200 billion to $400 billion. That is the injection that we are. That's the injection that we're seeing today. Now we can debate for hours about what is that $400 billion productivity. I mean, next year probably the revenue generated for these companies is not going to be more than the depreciation on the capex. So it's not going to be a great thing on the income statement necessarily. But long run, this is an existential threat for many of them. So this money is going into the economy. But if you look to the other side of the graph, a lot of that money is going into real world things, electricity, commodity demand. Even for South Africa, something like ruthenium is very important in data center expansion. And we've seen that the other side, we have seen very little investment in commodities. So when we think big long term, where are commodities in general going to go? Anything within this trend should be above inflation. So while we cyclically see some negatives, structurally we do believe real world assets can outperform above inflation and also just be general pressure onto inflation. So we've seen US inflation this year really spike, a strong spike with the tariff policies, but we've also seen inflation expectations, well, we'll see later today, but it's basically probably on par with South African inflation expectations, hovering in the high 3s. So this really does ask questions about what we've seen come through in the bond market and what should be the cost of capital if you think about the dollar. And that's further, so when we're talking about all these risks coming up, the Fed is in a very difficult position. We've seen what is the labor, Friday non-farm payrolls, is the data correct? I mean, one moment Trump is saying, no, it's fake to the downside, and the next to this thing. So there's a lot of information that we need to take in every day. But the persistency in US unemployment as a lagging indicator as to where the real world economy in the US is something that is very difficult to bet against. This is telling you you should be cautious. Some interesting things, and there's always interesting parts in the market, but this is something that we should think about. And I'm not going to comment to that part. I mean, it's well priced in the US market, but for our more cyclical parts in the South African market, we should think about it because times are uncertain. Big thinking, 100-year graph on the left, that's the impact, that's where tariffs are going. So just thinking that, oh, we think this is going to happen because it happened 5 years ago. What's happening right now happened 100 years ago. There is some element of you need to adapt to what today is. And if you do not do that in your equity process, there are going to be some structural changes in the market. And also on the right, so the policy uncertainty is at new levels, both on trade and just in general economic policy. So a lot of questions being asked. And that has delivered why many have used gold as a diversifier in a 60-40 bond equity portfolio. If bonds and equities in dollars start to become positively correlated, I can tell you most asset construction in the real big pension funds, it doesn't work. You need alternatives, or you need gold. So that has been the driver of the gold price, incremental. Central banks, naturally also, we have spoken about it many times, with the US currently putting its foreign policy in a more direct manner, using some of the mechanisms that they've used against Russia. It's become clear to countries, if you want to be independent, you need to own less dollar and more gold. So these are persistent trends, but I think the more interesting component is we don't realize how liquid gold is. Gold is the second most liquid asset in the world. The amount of gold contracts on the physical gold is a massive multiplier. So it actually does not take a lot of demand. And we've seen interesting dynamics into precious metals. So I'm going to stop a bit there to think about when tariffs came into place. We weren't sure, is it going to be on... We thought gold was going to be excluded for a moment. There it wasn't. But we saw a lot of commodities move from London, Shanghai into the US. That created quite a physical tightness in other markets where we see these lease rates spike. Because basically you just used to go down to Rotterdam to go get your platinum, and now, no, sorry guys, all the platinum is sitting in New York because we were scared we were going to get a tariff and we tried to make a profit. So the dynamics in the market has been very fast evolving. But in general, these real world assets has done well. And a lot of what's going on today is saying that this might persist, even though you should be more cautious given the prices. The second kind of key building block I'm going to talk about is China. We've generally, always been optimistic on what China can deliver given its track record. I'm just going to need some water here. But the multi-year stabilization in the Chinese housing market is taking a little bit longer. So I want to walk over here. My mouth is so dry. Thank you, Eugene. So the Chinese housing market, it's been a multi-year process. We've seen lots of changes happen. 2016, 300 million tons of steel went into the Chinese housing market. It's 100 now. We've taken already 2/3 of the pain in the commodities. It's not such a big commodity driver. What it is a big driver to is the optimism of Chinese consumers and where we sit in that economy. So the prices have not turned. It's now almost 3 years of negative prices, depending what survey you look at. And unfortunately, on the right, you'll see that completions versus starts. I would have told you, I really like that starts to come down and completions to stay flat. That was the picture. Unfortunately, we are now seeing completions come down. So this is something that we think about when we talk about commodities, and why, as other speakers have said, not commodities are equal. And then on tariffs, so the Chinese have not completely, but have done a tremendous job to diversify themselves away from the US. So currently, you can see that they have broken away as a trade partner in the orange line. And Trump's policies as to replace some of low-end manufacturing out of China is going to be very difficult, given the unemployment rate. So this we are more sanguine about than some of the other risks. But we do think that China has got tremendous opportunities in structural elements in the stock market, some of which we obviously have access to on the local market via Tencent. But the overall theme is that you do not want to be betting big on top line in China. So you can see the deflation continuing. This is also a view where we were 2 years ago would have said we're going to see some movement here, a lot of dry capital in China, and so we're optimistic that if you can find great Chinese structural stories with margin expansion like Tencent, you should do well. For us on South Africa, we see signs of life, like other speakers have spoken about. So we see the PMIs pick up. Many of the leading indicators that we are following showing positive signs. Something that has not been mentioned today and at the conference this week is, where do banks see credit growth? So we, as any capitalist market, the bank credit growth is probably the best indicator as to where the business cycle is going. And right across the board, acceleration. Most business for loan growth, bull cases we've compiled from analysts saying bull case is 6.5. So you can see that's not much of a pickup from the 5.8. You can see that line move, but we're talking to some loan officers talking about 8% nominal. Now that would be a real injection. That could be a catalyst to South African growth. We know about the other impacts. The gold and platinum fiscus impact from the current revenue price is going to be 30 billion. We don't need to talk about VAT at the next budget because we've got the 30 billion that we fought about in March, which is always very fun for all fund managers. So the rand remains in a position where we know it's always undervalued, but the opportunity there versus terms of trade is saying you maybe be cautious to be too negative on the rand, and that's because the real rates are high. So I, like other speakers, hope we see we've taken a lot of pain to anchor these rates lower. We've seen a lot of movement on that. I'm hoping the SARB feels a little bit more confident to give consumers that little bit of a boost that they need. So that's kind of the three key themes for us. The US, watch out. Don't be. There's a lot of greed in the U.S. market. Look at some of those macro variables. China, be on your feet. Look for the Chinese government stimulus. Otherwise, it might be tracking along on the top down. And SA, where everybody's fearful, maybe be a little bit more greedy. So, yeah. Thanks.